Welcome to Connect the Dots, a production of Industry Intelligence Incorporated. I'm your host, Nevin Barich. This week's topic, fast food, a tale of two trends. The second quarter of 2020 marked the first time that fast food chains were subject to an entire quarter under the shadow of the coronavirus pandemic. Many of these companies posted their earnings reports last week, and they were, in a word, bad. Not that we should be surprised. All of these companies lost virtually their entire dine-in business during the quarter. Yeah, we had that brief period where states started opening up too quickly and we started opening up more of these stores. But then COVID-19 cases shot up again and stores had to once more close down. Now, dine-in business is big business for these companies. I mean, just think about it. Last quarter, parents couldn't take their kids inside a McDonald's for a Friday afternoon treat after school or maybe after a Little League game. And a lot of Starbucks customers like to spend their entire morning or afternoon in the store working on their laptops. Can't do that anymore. So how bad were the financial numbers? Bad. McDonald's net profit fell more than 69% from the year-ago period. Dunkin' Brands' profit down 35%. Yum Brands down 29%. El Pollo Loco down 61%. And Starbucks? In the second quarter of 2019, the company made nearly $1.4 billion. In the second quarter of 2020, Starbucks lost more than $678 million. It's bad. Bad enough that some of these major chains are already looking to close stores. Dunkin' may be closing up to 800 U.S. stores by the end of the year. McDonald's is fast-tracking the closure of 200 stores. Starbucks is looking to close 400 North American stores by the end of 2021. And according to a recent report by Yelp, nearly 16,000 U.S. restaurants have permanently closed down since the arrival of COVID-19. So yeah, the current situation is bleak. But the future may not be. And here's why. Fast food chains are now putting much more emphasis on takeout, drive-through, digital, and delivery, services that don't require you to walk in or stay in. And this emphasis, which these companies feel is going to be a long-term trend, is already paying off. Church's Chicken, for example, reported an increase in drive-through sales of up to 20% since March. Chipotle, in the first quarter of this year, reported an increase in digital sales of more than 80%. And Starbucks, which remember got hammered last quarter, reported a 6% rise in mobile orders in the second quarter, making up 22% of its total transactions. Now look, it's easy to say, okay fine, fast food is putting more muscle elsewhere, but it doesn't make up for the money they're losing. And yeah, for now, that's true. However, in the long run, this is the best play for two reasons. First, fast food doesn't have a choice. Dine-in services close. And second, consumers are becoming more accepting of using these other avenues to get their fast food. New research shows that 36% of millennials now use a drive-through to get their food, up from 21% in 2019. And nearly 50% of baby boomers are now more likely to order ahead by phone, app, or website to get fast food. So connect the dots. Fast food companies lose money from the lack of dine-in service. So fast food focuses more on other types of services. And consumers across the age groups are embracing those other types of services. As a result, those other types of services are the lifeline for these companies. They are the light, the distant light, at the end of the tunnel. Thanks for listening to this week's episode of Connect the Dots, a production of Industry Intelligence. Want to find out more about Industry Intel? Want to hear more episodes? Read our blogs? Meet our team? Find out how we make businesses do better? It's pretty simple. Just go to www.industryintel.com and check us out. Thanks for listening. I'm Nevin Barich. Until next time.